Okay, let's dive right in. We're going to unpack one of the most important financial books ever written, Benjamin Graham's The Intelligent Investor. We're going to distill its core wisdom to figure out why its lessons on building wealth, on understanding risk, and most importantly, on our own psychology are maybe more critical right now than they've ever been. Believe it or not, that's a quote from Sir Isaac Newton. Yeah, that Sir Isaac Newton. He said this right after losing an absolute fortune. We're talking the equivalent of over $3 million today in a stock market bubble. Think about that. This was arguably the most intelligent person on the planet, a certified genius who literally wrote the book on the laws of the universe.
And that really gets to the heart of the problem, doesn't it? If a guy like Newton can get completely wiped out, what does that say for the rest of us? His failure proves pretty definitively, but in the world of investing, a high IQ and raw intelligence just aren't enough. The market is driven by human emotion, by what he called the madness of the people, and that makes it a really, really dangerous place.
So, how in the world do you navigate all that madness? Well, the answer, according to one of the world's most successful investors, is right here, in this book. It was first published way back in 1949, and it basically offers a timeless roadmap for making smart decisions when it feels like everyone else is losing their head.
And that successful investor? Well, of course, it's Warren Buffett. He was actually Benjamin Graham's student, and he first read this book when he was just 19 years old. He called it then, and he still calls it today, by far the best book on investing ever written. I mean, that's not just a recommendation, right? That's the ultimate seal of approval.
So, who was this guy, Benjamin Graham? Well, you can think of him as the father of modern value investing. Before him, Wall Street was kind of like a casino, mostly driven by gut feelings, superstition, and pure guesswork. Graham was the one who showed up and said, no, 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 this should be a profession, one based on logic, on analysis, and on discipline.
So, if he changed the entire game, what was his big idea? What was the one revolutionary concept that turned everything on its head? It all comes down to this one very precise definition. Graham drew a hard line in the sand between investing and what he called speculating. He said a true investment has to meet three criteria. One, you've done your homework, your thorough analysis. Two, it promises safety for your initial investment, your principal. And three, it offers an adequate return. Notice he didn't say spectacular, he said adequate. Anything, and he meant anything, that doesn't tick all three of those boxes, that's just speculation, period.
And this chart breaks down those two different mindsets perfectly. An investor asks a fundamental question: what is this actual business worth? The speculator only cares about one thing: will the price of this stock go up? See the difference? The investor uses the business's real value to judge the stock's price. The speculator does the complete opposite. They let the price movement dictate their sense of value. It's a total inversion of logic. And this distinction allows you, as Buffett likes to say, to profit from the market's folly instead of participating in it. And believe me, this folly is everywhere. This number, 105%, was the annual turnover rate on the New York Stock Exchange back in 2002. What that means is the average stock was being held for less than a year. People weren't investing in businesses, they were just renting stocks. And this isn't some ancient history, right? We see the same speculative fever today in meme stock frenzies, in cryptomanias. By Graham's strict definition, it's pure speculation. This is where Graham's wisdom gets really profound. He figured out that the biggest risks you face in investing don't actually come from the market, or a bad stock, or a shaky economy. Nope, they come from right here, from within. Our own emotions, our impatience, our fear of missing out, our tendency to follow the herd, that's what gets us in trouble. We are our own worst enemy. So, how do you defeat that enemy? Well, Graham gives us a set of core principles, a kind of toolkit for emotional and intellectual discipline. It all starts with remembering that a stock isn't a lottery ticket. It's a tiny piece of an actual business. It's understanding that the market is just a giant pendulum, swinging back and forth between crazy optimism and total pessimism. Your job is to take advantage of that, to buy from the pessimists and sell to the optimists. But the absolute foundation of it all, which we'll get to in a minute, is this idea of insisting on a margin of safety. Because ultimately, your financial fate doesn't depend on your IQ. It depends on your discipline and your character. Now, Graham was smart. He knew one size doesn't fit all. So he broke investors down into two types. First, you have the defensive investor. Their main goal is to avoid serious mistakes. They want a simple, low-effort strategy that lets them sleep at night. Then you have the enterprising investor. This is someone who is willing to put in the time and the hard work, the deep research, to try and get better than average results. Figuring out which one of these you are is one of the first, most important steps.
And that brings us to what is probably the single most important concept in this entire book, the margin of safety. The idea is actually incredibly simple. It's the principle of buying something for significantly less than what you've calculated its real value to be. That gap between the price you pay and the value you get, that is your buffer. That's your protection against being wrong, against bad luck, and against a future that you can never, ever predict.
This quote here from Jason Zweig, who updated the modern version of the book, just perfectly sums up Graham's ultimate lesson. Look, you can't control the market. You can't control the economy. You can't control what your stocks are going to do tomorrow. The only thing you can truly 100% control is your own behavior. And that, more than anything else, is what will determine your success.
So all of this leaves us with a final, really crucial question we all have to ask ourselves. When you buy a stock, are you following a disciplined process based on real analysis and value? Or are you just hoping the price goes up? To put it another way, are you building a portfolio or are you just placing a bet? Graham's timeless wisdom challenges every single one of us to know the difference.